Many of our stocks are down 80%, some are down 90% from their peaks, which is just ridiculous. Many people consider what we're doing to be extremely risky, and it is volatile. It is volatile because the future is filled with uncertainty. We are very data-driven, very research-driven, and so many people ask me why I have such strong conviction. How could I have such strong conviction when these stocks are down that much? It comes directly from our research, and if you don't think we are double-checking and triple-checking our research and our assumptions going into the research, and basically our clients and the social world is helping us battle test those assumptions. What we see as our stocks go down 80 to 90%, if we're right, we're seeing the total rate of return expectation increase for the next 5 years. So we keep our eye on that prize, and if our research is correct and the world has not changed, we've just moved into a risk-off period with inflation and interest rates, the reason our stocks are going to be dumped, we wouldn't be selling our stocks, we'd be picking them up, and that's what we do. We average down during risk-off periods, and we also concentrate our portfolios towards our highest conviction names. So we've moved our flagship portfolio, ARKK, from 58 names down to 32, 33 names. We're further consolidating in this risk-off period, but we tend to bottom out in that low 30s range. What I often say, and this was the refrain when it came to Tesla in early 2019, when, my goodness, the traditional asset management world was saying, well, this company's going bankrupt, it's running out of cash, can't scale the Model 3, and our research was telegraphing something completely different. And my answer to our critics at that time is, wait a minute. The markets are not closed. This is not 08, 09. If you look at the very loyal shareholders on the front page, you will find a group of holders that if you do an IPO, a secondary, we're going to be buying into that secondary. So, and that was absolutely right. And that's how I feel about the stocks in our portfolio right now. We are not a generalist strategy. We know who we are. We're focused exclusively on a slice of the market. And it is up to asset allocators, not us. We're not an asset allocator. We're giving asset allocators an opportunity to make up for the massive short that we believe they have in their portfolios. And that short is truly disruptive innovation. That's all we do. So those who are saying this, and I've seen some wirehouses saying this, but if you go to their due diligence departments understand what we are. We are a slice of an equity portfolio, and it is up to advisors or asset allocators, other asset allocators, to determine how big a slice of the pie our strategy should represent. That's not our decision. Advisors know their clients better than we do.
Sure.
And we just do one thing. We don't have to worry about asset allocation. We believe filling an unmet need in the marketplace, and yet many people consider what we're doing to be extremely risky, and it is volatile. It is volatile because the future is filled with uncertainty. The bad news is that the Fed has become extremely aggressive and hawkish. The good news is that we are beginning to get data that is confirming that the U.S. economy is in recession. And if you've tuned in before, you know that we believe that Europe and China effectively have been in recession as well. So now a global recession. We're also getting a lot of indicators that prices are coming down. And I think this notion that the inflation that everyone has been worried about is quite a wrong way of looking at the world right now. We believe that deflation is the much bigger risk. We've been saying this for a time. We've been ridiculed for saying it. And we were challenged by those who were sure that we were back into a 70s style inflation scenario. We think the pricing action, and I'm not just talking about stocks and bonds, I'm talking about commodity prices, crypto prices, and perhaps soon even housing prices, that many people will conclude the greater risk is deflation. And as you know, we don't think deflation is a bad thing per se. It is a bad thing the way the Fed has approached it, we believe. But deflation can be a very good thing if it is caused by technology and progress. And we think we're going to see a lot of that over the years. But right now, we're looking at bad deflation. And we're going to have to get through this. I think the next Fed move is supposed to be at the end of this month. And the Fed is out of its quiet period, so all the Fed governors have been traipsing out, saying we're going 75 basis points, another 75 basis points. Well, we think that they will rethink that in this month as we get not only more pricing signals, but earnings reports and guidance for companies who will be probably confirming that the U.S. is now in recession. So bad news, good news. Darkest before the dawn. We think growth is going to be scarce this year. And as you know, innovation is all about growth. Innovation is also about solving problems. We have a lot of problems now. A recession is going to be providing another set of problems. So lots of work for innovation to do, and that's where we believe you will find real growth. I did a tweet thread last weekend and basically concluding that the Fed right now is much more worried about its own legacy than it is about the economy. It is so afraid that it has let the inflation genie out of the bottle and that it won't be able to get it back, that it is in unison basically going out there and saying, we are going to tighten. We have an unconditional commitment to 2% inflation. Well, I'm going to be sharing with you a lot of indicators that will suggest that using the CPI as its guide, the Fed is making a big mistake. There's already a lot of deflation in the economy. And one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We have gone from 0.25% in the Fed funds rate to 1.75% in the span of 3 months. That's a 7-fold increase. We've never seen that before. Now, I know a lot of critics are suggesting, oh, what are you talking about? From such a low level. You can't make a comparison to the early 80s when Fed funds rate went from 10 to 20%, which was only a 2-fold increase. You just can't make that comparison. Well, yes, I can. I can make that comparison up 5-fold very quickly. And I think the Fed has panicked and it's causing the economy a lot of problems. As I mentioned before, though, it's becoming obvious now, and I do believe they will change their tune with a few more reports. I want to spend a little time on crypto. It has been an incredible month, and fears of systemic collapse have been rife in the marketplace. So we've seen Bitcoin, it peaked way back in November at 69,000. It is still higher than its pre-COVID 7,000 to 10,000 range. And it is just about at its 2017 high. So this could be some support. It is below its 200-week moving average, which is at 22,500. So there is some concern that that is the new resistance. Now, as we've seen the last month play out, talk about a reach for yield. Crypto personified that, DeFi personified that. And we knew that the Luna Terra experiment with algorithmic stablecoins was not going to work. It was backed by nothing. And I remember we did a podcast with Do Kwon. It's still on our site. And I remember listening to it twice because I couldn't understand what he was doing or saying. I am an economist by background, so I really do try and noodle through these things. And I just didn't think that was going to work. And it failed in spectacular fashion in May and has taken Celsius down with it, Voyager Digital, 3 Arrows Capital, BlockFi almost. It was very interesting to see BlockFi's last funding round around at $3 billion. This is a lending platform, and tried to do another round recently at $1 billion. He couldn't get it done, and it's not just happening in crypto. Klarna just announced, I believe, that its last round was in the $45 billion range. This is a fintech company, and it is doing around now at $6.5 billion. So big down rounds happening very quickly. We have a lot of on-chain analytics, which give us a sense of the capitulation in the marketplace, and also a sense of what is going bad out there. The transparency in the market, I think, is the reason we've seen a lot of failures very quickly. We have, compared to the opacity in the traditional financial markets, I think the shakeout in crypto has happened sooner and faster than it would have in the traditional financial markets. It's transparent, and there's a lot more trust in the crypto ecosystem because of the transparency and the over-collateralization than I think there is in the traditional financial markets. And when we wonder why are the CDSs going up on these banks, we wonder about the reach for yield and how leveraged some of these situations are. And we don't know where they're hiding. And so maybe that's all this is like, okay, the crypto market has alerted us that this reach for yield went way too far, and there are too many excesses, too much leverage around it. Hedge funds leveraging 10 to 1 when yields are 2% so that they can reach their return objectives. Maybe there are some problems out there, and we will find out. But for right now, I'm relieved, number one, that we have so many signals that will get to the Fed in some way, shape, or form, even if they have to wait for the CPI. They will get into the CPI, and that they are suggesting to me that the Fed has already gone too far, and that if it increases rates again, I doubt it'll be 75, maybe 25 or 50. I even think that will be a bit too much given what's going on out there and given the recession we're in. But at least the numbers, and part of this is downward revisions. Originally, the Fed thought these numbers were very strong, consumption very strong. No, consumption's falling apart. So believe it or not, bad news is good news now, as tends to be the case in a bear market when inflation is a concern. So bad news is good news, and it's always darkest before the dawn. I believe we've passed the darkest place. There are others out there. We're reading them in the press. They say we're only halfway there. I think they follow algorithms. I've watched a bunch of algorithmic behavior that, just chases an idea until it stops. And I think we're getting close to that point where they, who seem so right with their negative stance over the last year or so, will be on the wrong side of that trade.